Good evening, ladies and gentlemen, and welcome on behalf of Benjamin Tall and myself and CIBC and all of us at Peerage and all of our family, colleagues, family, and friends, partners and friends. We're thrilled to have Benjamin Tall to be with us this evening. He is a world-renowned economist, and our timing is quite fortuitous in light of the Fed meeting today and the increase in the Fed funds rate by 50 basis points. So we have lots to cover. Benjamin, thanks for making yourself available. And it's a pleasure to have you. And we'll do the format that we normally do. You have a presentation, and then we'll get into Q&A right afterwards. So please go ahead. Welcome.
Okay, thank you very much. A pleasure to be with you. Listen, I have about 30 minutes to tell you everything I know about the situation. That's probably 29 minutes too long, given the uncertainty that we are dealing with. So I'm going to divide my presentation into three parts. The first part will be about inflation. The second part will be about inflation. And the third part will be about inflation, because you want to know where this market is going. You want to know where interest rates are going. You must have a narrative about inflation. And after talking about inflation for 30 minutes, I will tell you at the end of the day, this is not about inflation. This is about the cost of bringing inflation down to 2%. We have to understand that. This is extremely important to understand. The Bank of Canada, the Fed, have this credibility to maintain, the credibility of inflation fighters. They are not going to toss it away. They will do whatever it takes, including taking this economy into a recession, to make sure that we go back to 2%. You wake up the Bank of Canada in the middle of the night and you give them two options. One is a recession, the other is inflation. They will take a recession any day. That's the way to look at the situation, and then we can proceed. Now, given this environment, let's go to the first chart, and I would like, if possible, if I can see the charts. Is it possible for me? Because I don't see the charts now. Okay, that's wonderful. So I want you to focus on this chart. This is an important chart, and I want you to focus on the left side of the chart for a second. The question is to what extent we are back to the 1970s. Look what happened in the 1970s. 1973, inflation started to go up. We all know the oil embargo. We know the story. Look what happened to inflation expectation, which is the red line. It really didn't go up much. What the Bank of Canada, what the Fed care about is not inflation that you read in the newspapers. It's inflation expectations, what you and I think about inflation tomorrow. And as you can see, in 1973, inflation did go up significantly. Inflation expectations didn't. Why? Let's go to the next chart. Because back then, the Fed, in their commentary, basically told everybody, don't worry, be happy, inflation is not going to last for too long. It will peak within 2 months and everything will be back to normal. It took inflation more than a year to peak. So the Fed lost its credibility. Let's go to the next chart now and see what happened. Look now at 1977. Inflation went up. Look what happened to inflation expectations. Immediately up. No trust, no beliefs that the Fed will take care of the situation. The minute inflation went up, inflation expectations went up. And the minute you have inflation expectations up, you lost the game. And that's why we went through the double dip recession in the 1980s to break that inflation and inflation expectations. Now focus on the right side of this chart. See where we are now. Inflation is up, we all know that. Look what's happening to inflation expectations, still subdued. That's what the Fed and the Bank of Canada are focusing on. They want to make sure that it remains subdued. They want to make sure that we understand that they mean business before we do anything else. And therefore, they will do whatever it takes to keep this red line muted. Now, let's go to the next chart and discuss those expectations. First of all, what we are seeing now, that everybody is expecting the 1 year inflation to be up, and that's not a big surprise because it's already up. But look what people expect for the next 5 years. They expect the Fed, the Bank of Canada, to win the war, and inflation will remain low in the next 5 years. That's extremely important. That's what people believe. Let's go to the next chart and see what other things are people believing, because it's important. You can see that this system of belief is very diverse. You have about 25% of people believe that inflation will be below 0 3 years from now. Namely, they believe that interest rates will go high so much that it will take the economy into recession and inflation will be 0. Then you have about 40% of people believing that inflation will be above 4% 3 years from now. Namely, the Fed will lose the game. And the Fed will not be able to reach that target. That's what 40% of people believe. Now, let's go to the next chart and show that those people that determine expectations are not very well informed. They were, just recently they asked a question: is this the most inflationary period we have ever seen? 50% say yes. Another 1/3 said we don't know. Only 15% got it right, because inflation now is not the highest ever, of course. The 70s was higher. So why people are so wrong? Because they are ignorant. Why they are ignorant? Because of the next chart. That's why. How do you get these kind of answers from? Where? From social media. Social media is perceived to be, listen to this, the most credible source of information on inflation. Not a joke, that's a reality. So think about it for a second. The Bank of Canada is trying to understand what we are thinking about inflation. We are thinking about inflation based on social media, which means that the Bank of Canada is influenced by social media when it comes to decisions. Now, there's good news. There's good news. In fact, very good news. The Bank of Canada has a Twitter account. The bad news is the next chart. Nobody is following them, which means that the Bank of Canada cannot tweet its way out of inflation. They have to show us that they mean business, and that's why they use this kind of language, and they have to make sure that they act. And that's why interest rates went up by 100 basis points, by 50 basis points, by 75 basis points, to make sure that we understand that they mean business. Now, given this background, we're ready to discuss actual inflation. And about 50%, 1/2 of inflation now, is one aspect of inflation, and that's supply chain. Because when you talk about inflation in general, it's very overwhelming. So you want to focus on the sources of inflation, and then discuss how much of this source is inflationary, how much of it is durable, how much of it is COVID or not, and then say something about inflation. Supply chain is 50% of inflation. In our previous discussion, we discussed supply chain a lot. We know what it is. Now let's go to the next chart and see where we are on this one. Well, in January of this year, the Bank of Canada went to the market and said, by the second half of the year, supply chain will disappear. By July, they came to the market again and said, remember what we told you in January? We were just joking. Supply chain will last longer. By October, they basically gave up. And they say supply chain will remain forever. We'll discuss it, because we have to understand one thing. Although supply chain is now much more complicated because we have this semi-deglobalization, the situation is improving dramatically. Let's go to the next chart, which is very, very important. At any point in time, there are 3 forces of inflation. Inflation driven by supply, demand-driven inflation, and we don't know driven inflation, something in between. But as you can see, 50% of inflation is coming from supply. Now, look at the gray line that is going down. I follow this very closely. To me, that's one of the most important indicators regarding inflation, because what it means that the share of inflation that is coming from supply, namely outside the country, Russia, China, supply chain, is going down. Why is it important? Because the Bank of Canada and the Fed can talk about inflation until they are blue in the face. They cannot do anything about it if it comes from supply. You raise interest rates, it impacts the economy domestically, not outside. So they cannot do anything about it. Now, every basis point decline in the share of supply-driven inflation is enhancing the ability of the Canadian Central Bank and the Fed to deal with the situation, because more and more inflation is domestic. There they can do something about it. So the Bank of Canada is more effective when the gray line continues to go down. And if you go to the next chart, we can say that it will continue for sure. Why? Because it's already happening. I want you to focus on the red line. This is the, if you wish, the supply chain headache index coming from the New York Fed in the US. You can see that it's down, which means that it's improving. What does it mean? It means that you have freight activity almost back to normal. You have shipping costs down notably. Today in the US, You have 20% more truck drivers than before COVID. Things are improving. They're not perfect, but they are improving. The only issue that we have in Canada is really the port of Vancouver, where we have bottlenecks, but that's a totally different story. Now, look at the gap between the prices of goods and supply chain. That's why I know it will continue. That's why inflation is starting to surprise on the upside, on the downside, namely surprising in a good way. You can see that goods prices follow the example of supply chain pressures. So we know those prices will ease over the next few months. Another factor is the next chart, and that's what's happening in the global economy. We know that Europe is basically in a semi-recession or maybe in a recession because of oil prices, natural gas prices. Russia, we know the story. Look at China. China, for the first time, is unable to lift the global economy. Why? Look at the trajectory of the Chinese economy in 2022. It's basically the same as it was in 2021 during COVID. Why? Because of zero tolerance to COVID. We all know the story. In addition, for the first time, the housing market in China cannot save the day. It's basically in a free fall, especially in second and third tier cities. Developers cannot get the money to build, so the housing market is slowing down notably. So China is expanding by maybe 3% if they're lucky. That's basically China in a recession. So the first time in a long time, China cannot lift the global economy. And that's why if you go to the next chart, commodity prices are easing very quickly. That's very good as far as the Bank of Canada and the Fed are concerned, because it means that inflation will continue to go down. Therefore, with supply chain improving, commodity prices slowing, we're already starting to see inflation slowing. We are getting very good numbers from the US and Canada, and that will continue. So if we are at 7% inflation now, the move from 7 to 4 will be very quick, very quick. Already on a year-over-year basis, the gasoline prices are negative in terms of contribution to CPI. So the move from 7 to 4% will be relatively quick. Let's say by spring, we might be there. The trick is to move from 4 to 2. That's the domestic part, which is more complicated. So let's go to the next chart. We definitely have to discuss the economy. And everybody's talking about this recession, and it's true that we are basically on the verge of a recession. October GDP is 0%, so we are talking about basically close to zero or negative. However, there is a big difference between a recession and what I call a wannabe recession. What we are entering now is a wannabe recession, namely a recession on paper. Namely, GDP will be zero or negative, but the labor market will still be strong. A real recession is a recession in which the unemployment rate goes up significantly. Therefore, we must discuss the labor market in order to understand what's happening, and the labor market is very interesting. So let's go to the next chart. And that's basically the story that we are seeing. Companies cannot find people. I'm hearing stories that businesses have to pay for people just to show up for an interview. That's how crazy the situation is. So the question is, where are they? Whenever we get the employment numbers from Stats Canada, the first number I look at is the vacancy numbers. We have 1 million vacancies. The question is, where are they? Where is everybody? So people said they're all at home watching soccer. You know what? I don't think so. I don't think so. I think if you look at the participation rate in the labor market, it's basically back to normal. So something else is happening here in a big, big way, and we have to understand that. So let's start discussing it and see what makes sense and what doesn't, because if you go to the next chart, you can see that something big happened during COVID. This is the relationship between the unemployment rate and vacancies. And you can see that this relationship, of course, is negative. But you can see that this curve shifted during COVID. Basically, for a given level of unemployment, the vacancy rate is much higher than it used to be. So the question is, where are they? Let's go and explore. It's very, very important. Let's go to the next chart. Let's call it as it is. Some people don't show up to work simply because of the fact that they are sick. They are simply sick. You have 16 million people now in the US with long COVID. In the UK, almost 1% of the population has long COVID. Now, the duration of long COVID is about 3 months. And you can see that in the US, it is more important than retirement in terms of the impact on the participation rate. Now, this will improve. I think that a reasonable working assumption about COVID is that we are moving from a pandemic to an endemic. I think that's a reasonable scenario. Namely, COVID will be with us, but it will not dominate us. So this number eventually will go down. But if you want to understand the labor market, you have to understand that. Let's call it as it is. The next chart is even more interesting. In a normal recession, not like this recession, in a normal recession, you lost your job. Let's assume that you were an employee for Air Canada. You lost your job. You went on employment insurance for 6 months. The recession was over. You went back to Air Canada or you went back to any other airline. Today, after almost 3 years, you moved on. You are in a totally different industry doing totally different things. This measure is a proxy of people moving from one industry to another. So if you are Air Canada, you have to start fresh. You have to start looking for people. You have to train them. And that's exactly the other day why my flight was delayed by 2 hours. So this takes time. Eventually, Air Canada will find its people, but it will take time. And that's something that is contributing to the structural problem that we are seeing. But more than that, let's go to the next chart and see something very, very interesting. Look at the chart to the left. This is the share of low-paying jobs in the labor market. It's down. Now, in the beginning of COVID, that made sense because all the jobs that were lost were low-paying jobs. But today, the labor market is back to normal. Everything is back to normal. But this share of low-paying jobs is still in the basement. So the question is, again, where are they? Now, let's go to the next chart and see something fascinating. Look at this. We created 650,000 new jobs since the beginning of COVID. 650,000 new jobs. Basically, all of them are university-educated individuals. That's fascinating. Fascinating. So the question is why? And I believe that COVID opened up the market for educated people. You see, before you were educated in Toronto, but you didn't have a job, you couldn't find a job, you were serving coffee at Starbucks. Today, you are in Toronto, you cannot find a job, you can find a job in BC, in Alberta, or in New York, Zooming, virtual. Basically, COVID opened up the labor market for educated people, as we can see from this chart. But nobody's left to serve coffee, you see? So that's a significant force that we have to understand. In addition, if you go to the next chart, you can see what we are talking about. We are in a wave of retirement. But if you look at the people that are retiring, they are low wage, low education. So the people that are entering the labor market are high wage, high education. The people that are exiting the labor market, low wage, low education, the share of low paying jobs going down. And that's very, very important. So if you go to the next chart, you can see what it means. It means that there is a clear negative correlation between vacancy rates and wages. Namely, the higher the wage is, the lower the vacancy rate is. So the demand is for low-paying individuals, low-paid individuals. That's what the demand is. That's what we need. We need people at the low end of the wage interval. That's where the demand is. That's where all the vacancies are. Now, in Economics 101, they teach you, if you don't have enough of something, the price of this something will go up. Namely, the wage of low-paying jobs will go up higher, faster than any other wage category. If you go to the next chart, you can see that this is really what's happening. The wage distribution is basically uniform. You see the bottom quantile, the bottom 20, it should be double that. It should be basically double that. It's not happening. Why? Because small businesses that employed most of those low-wage individuals don't have the margins. Remember, just a few years ago, they had to deal with a significant increase in minimum wage. They don't have the margins, and everybody's talking about this recession coming. Do you really want to start raising wages just before a recession is coming? So they're not doing it. So the market is not clearing. Economics 101 is really not working. And that's actually very good news as far as the Bank of Canada is concerned. Why? Because if the wage pressure is coming from beneath, it trickles up. It goes to the second 20% and the third 20%, and it's more durable and more inflationary. The fact that it's not happening means that actually this cycle of wage inflation is not as durable as other ones could have been. That's very good news as far as the Bank of Canada is concerned. So what we do on a daily basis, we look not only on the absolute wage increase, but also the composition of wage increase, where it's coming from, bottom 20 or not. And the fact that it's not moving the way Economics 101 is telling you suggests that the wage inflation that is coming is not as terrible as it could have been, something that is very good news as far as the Bank of Canada is concerned. Let's go to the next chart and discuss something else that is important, and that's, of course, the housing market. We all know that the housing market was on fire during COVID. We had a situation in which prices went up by what, 46% in 2 years. The question is why? That's because of the asymmetrical nature of this crisis. All the jobs that were lost were low-paying jobs, renters, and that's why rent actually went down. Home buyers were benefiting from the recession. Why? Because their job was there, their income was there, and interest rates were in the basement. So we had a situation in which home buyers got the benefit of a recession vis-a-vis extremely low interest rates without the cost of a recession vis-a-vis a broadly based increase in the unemployment rate. We have never seen anything like that. That's the story. There was a sense of urgency to get into the market during COVID, and that sense led to front-loading activity. People basically borrowed activity from the future, and the future has arrived. We are in the future. So this is not a crash. This is not a meltdown. This is reallocation of activity over time. So you can see that this market is still basically on average, on balance, in balanced territory, not all buyer's market, not seller's market, somewhere in between. But when you look at Toronto, Vancouver, we are getting closer to a buyer's market. Let's go to the next chart and see what's different this time around. Usually, when you have a correction in the housing market, listing go up, supply goes up in the resale market. That's not happening now. There's no supply. If you are in the market, you know that there are no listings. So this is the first time that listing is down, and that's protecting prices from falling even more. So the question is to what extent that will continue, or what we are going to see in 2023 when the fog clears, to what extent there will be more listings that will lead to some downward pressure on prices, in addition to what we are seeing now. Let's continue to the next chart. And that's, of course, the mortgage market. And the mortgage market is slowing down notably. Origination is negative, outstanding about 5%. And that's really, really important because we know that there is an army of people, and let's call it as it is, that are now in a trigger rate situation in which their loan is 100% interest, zero principal. I estimate about 15 to 16% of mortgage outstanding are in a trigger rate situation where they're basically not paying off their principal, and all their interest payments goes towards interest payments, and that's it, not towards principal. That's important to understand. And remember, in 2023, we estimate that the extra increase in spending on debt financing for people that renew will be about $340 a month. That's in 2023. That's not huge. However, in 2024, when people that took a mortgage in 2020 or 2019 and will start refinancing it or renewing that, that's when you're going to see a more significant increase in payments. That will be a major shock. Remember, for many people in variable rate mortgages, the rate went up from 1.5 to 5. That's a significant one. They are not seeing it now. They are not seeing it now, but they will see it in a year or 2 years from now. And the hope is that interest rates then will be lower than they are now, and we'll discuss interest rates in a second. But clearly there is some vulnerability in the market that will prevent the economy, prevent the housing market from improving dramatically, and will put actually some pressure on it just because of that. Now, in addition, we have, if you go to the next chart, that's the extra payment that we are seeing in 2023, 2024, and that's reasonable, but still a significant increase in payments that we have to deal with. You go to the next chart, and you can see that so far we are not seeing any stress. I'm looking at the signs of people not able to pay. I don't see it yet. Not yet, but maybe some early signs. Namely, I look at the margins of the margins. Subprime, 30-day delinquencies, starting to rise, but not in a very significant way. Why? Because the labor market is still strong. As long as the labor market is strong, delinquencies will not happen. It's only when the labor market is weak, and that's when we have to discuss interest rates and the Bank of Canada. But before that, one more thing, and that's the next chart. I still believe that the rental market will be on fire. The last time I had a conversation with you, I told you that I believe that the rental market will catch fire. It's doing extremely well in terms of growth in average rent. Vacancy rates are basically zero. You cannot find the rental units, and it's getting worse because you can see that the cost of owning a house has risen dramatically relative to the cost of renting, and therefore you will see even more rentals coming. And we are not building. We are not building. In fact, we are canceling or delaying projects. I estimate that 1/3 of projects that were supposed to go up in 2022 were delayed or canceled, which means that 2 years from now, when they're supposed to be there, they will not be there. You don't have to be an economist to predict what will happen to the rental market. It will be very, very tight over the next 2 to 3 years because we still have the demand. This year alone, we got 700,000 new people into this country. New immigrants, students, foreign students, non-permanent residents, and people from the Ukraine on a 3-year visa. So 700,000 people, nobody there carries their house on their back. They need to live somewhere, and we simply don't have the supply. Now, given all this, you're the Bank of Canada. What do? You are at 425 now. 425. You want to stop. Remember, just a few weeks ago in the previous move, the market gave the Bank of Canada the green light to go 75. They went by 50. Why? Because they don't want to overshoot. That's very encouraging because I believe, I told you in the past, that every economic recession over the past 50 years was helped, if not caused, by monetary policy error in which central bankers raise interest rates way too much. Why it's happening? Because inflation is a lagging indicator. Inflation is telling you about the past, not the future. So show me the central bank that will have the guts to stop raising interest rates or even start cutting interest rates while inflation is still accelerating. And that's why what the Bank of Canada did was actually an act of monetary policy courage. And they're telling you, we want to make sure that inflation is dead, but at the same time, we don't want to overshoot. So what do? You're at 425. I believe, and that's what I'm telling them, stop now. No need to continue. Stop now. The next question is, when do you start cutting? Usually, the distance between the last hike and the first cut is relatively short, not this time. I believe it will be a full year. I think they will not move until 2023, December, or maybe early 2024. Why? Because they want to make sure that inflation is dead before they start cutting interest rates. Remember the 1973-77 episode where they lost their credibility? That's their nightmare. They don't want to repeat past mistakes. So they will buy insurance in terms of time with higher interest rates before they cut interest rates. So let's say early 2024, they start cutting. Then by what? How much? We started this saga at 175, 445, 425 now, resting, cutting. By how much? I say to 3, maybe 275. A full percent higher than before. Why? Because we have 3 forces of inflation that are beneath. Before we had globalization, that was disinflationary. Now we have deglobalization. Back then was just-in-time inventories. Now we have just-in-case inventories. And back then the labor market was easy and cheap. Now it's very tight and expensive. All those forces are inflationary by nature. And therefore, you will see a situation in which when you have more inflation pressure, and at the same time, the target is the same, they are not going to change this target. The target is 2%. So you have 2% with more inflationary forces beneath. By definition, interest rates have to be higher in order to keep the target at 2%. And that's more or less what I see the Bank of Canada seeing. What's the risk? The risk is if something goes wrong with that supply chain business. If it doesn't improve, if something with Russia, China, supply chain, I don't know, something happens, COVID, and all of a sudden you have supply chain going back to what it was, and prices starting to go up, and this index that I showed you not behaving, that will force the Bank of Canada to continue to raise interest rates to fight inflation. And by definition, there will be overshooting. 5.5%, that will take you to not a wannabe recession, but a real recession with the unemployment rate rising. In a wannabe recession, what we are seeing is that the labor market will be shedding vacancies as opposed to jobs, and the unemployment rate will rise only to 6.5, 6.7%. If you have overshooting to 5.5% overnight rate, the unemployment rate goes to 8.5. That's a real recession. That's the risk to that scenario. But at this time, given the fact that the Bank of Canada is getting that, it seems that the most likely scenario is this milder recession with the unemployment rate rising by little, not very significant. I will stop here and see if we have time for a discussion.
So this is very helpful and very informative. First issue is, are the issues facing Canada and the US the same? I think there's a 50 basis point spread between the Fed funds rate and Bank of Canada rate. But do you think that the issues that the Fed is facing and the Bank of Canada are the same? And is the prognosis for the future and what initiatives they have to take to get inflation under control the same basic issues?
They are basically the same. The difference is the effectiveness of monetary policy. Basically, the reason why the Fed eventually will go to 5, as opposed to 4.25 for the Bank of Canada, is the effectiveness of monetary policy. There are a few things happening here. You have to go back to 2008. The US went through the mother of all deleveraging. Their debt-to-income ratio went down from 160 to 140. Ours went up from 140 to 160. Because this was not our recession back then. We were basically second-hand smokers back then, if you remember. Which means that we have more debt. When you have more debt, we are more sensitive to higher interest rates. I estimate that 1% increase by the Bank of Canada is equivalent to 2% increase by the Fed in terms of the impact on the consumer. So the tiny Bank of Canada is more powerful than the mighty Fed, if you wish, when it comes to monetary policy. That's one thing. So the Fed has to go higher to get the same result. That's one thing. The other, when the Fed goes up, it slows down the US economy. Slows down the US economy, it impacts our economy. When we slow down, it doesn't make any difference to them. So we actually seeing a substitution between the Fed and the Bank of Canada. The Fed goes, it's doing the Bank of Canada's job, so you don't need to go as high. And if you go back to the last 2 cycles, the Fed went up 75 basis points higher than the Bank of Canada. So that will be the case as well this time.
How concerned are you about the shrinking of the money supply in America and its impact on the economy, the flow of funds and liquidity for businesses, and probably the flow of funds for the consumer?
I don't know if I would say the word concern. I think that that's the way to fight inflation. I think that's what they are trying to achieve at this point, quite frankly. They're trying to slow down money supply. They're trying to reduce liquidity in the market. They're trying to increase the unemployment rate in order to fight inflation. So to me, that's a price that I'm willing to pay, quite frankly. However, I just don't want to overshoot. So when I communicate with the Bank of Canada, I said, I think 4.25 is enough. You create enough damage. And remember, the trick with the interest rates, it works with a lag. So what we are seeing now, the damage in the economy, including the housing market, is a damage that is equivalent to 100 basis points increase so far. We still have 300 in the pipelines that came already, that will impact the economy in the future. So you have to take it into account before you move.
So let's focus on the elements of inflation. You talked about money supply being 50% of the source of inflation.
No, supply chain.
Supply chain, sorry, supply chain. But we didn't really talk about the pressures of labor. We did a little bit, but when you read in the media and you read the pundits, their biggest fear is about labor, labor inflation and consistent pressures on labor inflation. Do you think over time the labor inflation issue becomes a bigger contributor to the challenge of inflation, or it reduces over time?
Yeah, I think that when I talk about remember when I said that the move from 4 to 2, will be the most challenging one. That's what I'm talking about. I'm talking about wages. I'm talking about the domestic economy. I'm talking about service inflation. And therefore, I think that by raising interest rates, you basically want to raise the unemployment rate, reduce the bargaining power of labor. The fact that wage inflation is not going up dramatically for the bottom 20 is actually not good for them, but it's very good for inflation because it means that it's protecting inflation. You look at the quit rate, and the rate at which people are quitting in the US is starting to go down. That's very highly correlated with wages as well. So we think that the wage activity will start slowing down with the labor market slowing and the unemployment rate rising. And I think that the vacancy numbers that we're seeing 1 million will start going down very quickly over the next year as the economy slows down. So I think that wage inflation will be there, but it will not be the 1970s. And remember, what's leading is actually higher prices lead to higher wages, not the other way around. So if you fight wages, if you fight prices, wages will follow suit. That's the way I look at the situation.
In your mind, where do you expect peak inflation to be?
We're already
and at
there.
what level?
We're already there. We were in peak inflation 2 months ago. So we are going from 9% to 7% on the way to 4% by spring. So we are there already.
I was reading Howard Marks from Oaktree, his latest memo called Sea Change. And he talked about the fact that, we're not going to get down to 2% anytime soon. That's not a realistic expectation, that 4% was probably a realistic one. And he also talked about that rates will probably be higher for longer. And that he didn't think rates were coming down till 24, 25 kind of period. Obviously, he didn't know any more than anybody else, although he's a smart guy. If that's the stock market is telling you a different story, right? I mean, the market is still down the S&P is down 16%. The TSX is down 6% this year, but they're up, 10% from the bottom, and down, and so what's the market buying into that the current economics don't dictate?
Okay, so there are a few things here. First of all, actually, I agree with a few things that he's saying. I also see interest rates starting to go down in 2024, going into 25. I believe in that. I also believe in higher for longer. I do believe in that. However, I think that the issue about inflation, we can make the point, given all those inflationary forces that I'm discussing, the deglobalization and just-in-case inventories and all this business, that the new inflation target should be higher. Why 2? 2 belongs to the past. Now we are in a different environment, so maybe 3, maybe 3.5. That's an academic discussion, mind, because the Bank of Canada will not change it. The Fed will not change it. I had a discussion with them about that, and they're not going to change it anytime soon for a few reasons. First of all, they just renewed their mandate, so they're not going to change. 2 is that they say, if I move from 2 to 3, like that, tomorrow people say, they can move from 3 to 4. You lose your credibility. So they're going to stick to the 2%, even if it means that you keep interest rates higher for longer artificially. And that's why I don't see 2024 being a very strong year, economically speaking, just because of that. So I agree to some extent in some of the things that he's saying. I do believe that eventually those prices will go down to 2%, but at a cost. The cost will be artificially higher interest rates, because I believe that the inflation target in this environment should be maybe 3%. But that's a different story. So let's talk just about the stock market. I think 2 things are happening. One is the market is sensing the end of tightening, and that's something that is working in a positive way. But another thing is happening here. All those forces that I discussed, the deglobalization, just in time, are also hurting profit margins. And the market has been very optimistic about earning per share, 6% for this year, for next year. That's too high. So the market is in the process of adjusting this downward. When we complete this process and interest rates stop rising, I think that would be a very interesting boost to the stock market.
So what I've read recently is that both central banks, and all central banks for that matter, are going to a neutral rate policy of real rates. So if inflation's 4, rates should be about 4. in order to to balance that. On the other hand, if inflation is lower, rates will be lower. If you had to probability weight the likelihood that rates by the end of 24 are 4% or less, based upon a Fed and Bank of Canada policy of being neutral against inflation, so therefore inflation will be 4 or less, how would you weight that probability?
Yeah, I think that the most reasonable scenario to me, with a relatively high probability of 60, 70%, is that inflation will approach 2% by 2024. Might be 2.5, might be 2.7, but approach 2%. And I think that the bank rate will be somewhere in between. Namely, it will not be 4.25 where it is now, but it will not be 1.75 where it was before the crisis. It will be 3. To me, that's a very reasonable neutral rate, reflecting that we are now overshooting a little bit and we'll have to slow down the economy, the interest rates, because the economy is slowing down. But at the same time, we don't go down to where we were because inflation is too high and the forces are too high. So to me, a nice compromise is somewhere in between, like 3%.
So most of us on the call do not really know the impact of inflation, in the sense that inflation technically is 2 consecutive quarters, a recession,
you mean?
two negative quarters of GDP growth. But if we're normally running at 2 to 3% positive GDP growth, and then we go through a period where at 0 to 0.5 or 2.25, doesn't that feel like a recession to the average consumer?
Not if you don't lose your job. You see, to me, a real recession, and that's why the people that decide whether or not it's a recession or not, they don't look just at negative GDP. They look at the labor market as well. And you can have, theoretically, 3 or 4 quarters of negative GDP without calling it a recession, officially, because the unemployment rate did not go up. That's not the case. But in this specific case, namely in the next few quarters, we might get a situation in which the unemployment rate will not rise very dramatically because we have the buffer of vacancies, but you might get negative GDP. It's other factors can impact it: export, inventories, business investment that don't impact the average consumer very much. And you can still get negative GDP, very mild negative GDP. So to me, the labor market is everywhere in this decision-making process. And that's why I spend so much time on the labor market in this presentation, because I think all the answers are there.
It reminds me of a funny story you just told that my late father used to say to me. The difference between a recession and depression is when your friend's father loses his job,
That's
it's
true.
a recession. When your father loses his job, it's a depression.
That's very true.
The stock market traded at a peak of 23 times. The S&P 500 traded at the market traded at 23 times the S&P earnings stream. Now it's at about 16, which has been the norm for many, many, many years. But if you look at, CNBC every morning, you see that the earnings of most companies, there are a lot of earnings disappointments. Do you see more and more pressure on earnings as a result of the supply chain issues?
Absolutely. And I think that's a good thing. I think that the disappointment is because of the fact that the market was way too optimistic. I don't see an environment in 2023, which is going to be a tough year, economically speaking, in which earnings per share goes up by 6%. I just don't see it happening. And the market is in the process of adjusting it. I'm waiting for this process to complete in order for me to be totally bullish on the stock market, because I think it's not really an interest rate story anymore. It's earnings story.
So rates have gone from virtually nil in America to, you said 4.25%. So call it up 400 basis points. Every 100 basis points is a $300 billion annual incremental cost. So 400 basis points is $1.2 trillion more. Besides printing money, how do they afford this, and how do they pay for it?
The way to pay for it is basically through pain. You need to see the unemployment rate rising. You need to see the economy slowing down. You need to see the vacancy rates disappearing. That's what they're trying to do. You need to see the housing market correcting. That's how you pay for it. You pay for it by pain. It's not somebody writing a check. Now, what the risk here is that governments will say, okay, we're starting to write checks. And we see it in the provinces. In Canada, it happens a lot. You get $500 here, $600 here. Even in the US, I think that the midterm elections was extremely important in terms of the potential impact on spending, because the Republicans basically will say, okay, you cannot spend anymore. And that's actually a good thing. Why? Because if you have a government that is spending and a Bank of Canada that is trying to slow down the economy via higher interest rates, it's like putting a humidifier and a dehumidifier in the same room and let them go at each other. It doesn't make any sense. So you have to make sure that fiscal policy does not sabotage monetary policy. And it's not very clear that it's really not happening in Canada with the provinces spending so much money.
So a lot of the people on the call are real estate people. So let's talk about some of the issues. You've got mortgage rates now at almost 7%, I think. In the United States, around, 6% kind of in Canada. When stress tests are done, they usually build in a 200 basis points buffer. The affordability of mortgage financing at this level is very low. What happens right now? You have two issues. You've got pricing has come down from the peak, but it's really more volume of transactions that's been negatively affected, not pricing. Although if you read some of the newspapers, they talk about a 25% decline in the price.
That's the average price.
Yeah, pardon?
That's the average price. That's price
Average
that
price.
takes into account the composition, which is not really the way to measure it.
But in relation to that expectation, we're nowhere near there currently, correct?
No. I think that if you look at the way to measure price correctly, namely apples to apples, condo to condo, low rise to low rise, we're down by 10%. And that, remember, prices went up almost by 40% in 2 years. So 10% is not enough, if you wish. And I believe that it will continue to go down a little bit over the next 6 months. And quite frankly, Miles, I see it as a good thing. I think that after you go up by 46% in 2 years, you need a break. Otherwise, you are in a bubble. And nobody wants a bubble, even if you are a real estate professional. You don't want a bubble, believe me. So the fact that the market is correcting now is very positive, in my opinion.
So in your mind, you think things go back to where they were in 2020? Is that a fair basic level of pricing of residential real estate average?
No, I think that if you look at what happened in between 2019 and 2022, it went up dramatically. I think we'll meet somewhere in between. You will lose half of it. You will move 60% of it, but you will not go back to 2019. Remember, the demand is still there. The supply is not there. So the fundamentals of this market are very, very strong. So I don't see you lose all the 46% that you gain, but you lose a notable portion of it.
So if you lost 40% to 46%, that's 18.4%. So we're about halfway there to where you think would be a fair balance.
Yeah, I think so. Yeah.
And supply right now, as you said, is dried up. There is not a lot of listings. Is that because people can't afford to finance a new home if they sold their existing one, or because they're not prepared to accept where the pricing on the sell side is relative to where the demand is for a buyer today?
Yeah, we do a lot of focus groups with potential sellers, and they basically say, I don't want to sell now with interest rates rising. We don't know exactly what's going on. It's too much fog. Let's wait. I'm not in a rush. So I believe in 2023, you might see more listing coming because the situation will kind of stabilize. That's one thing. The other, I think by 2024, we will see some forced sales, namely people that have to sell because they cannot refinance their house because the interest rate story is too high for them. They went from 1% to 5%. Even if interest rates go down, it will be 1 to 4%. Still significant. And therefore, I think that some of them will say, you know what, we are selling. So that will add to the supply story.
Defaults historically have been exceedingly low, especially in Canada. Do you see defaults as a factor at any point over the next 24 months?
If you ask me if they will rise, I say yes, they will rise. There is no question in my mind that they will rise. But are they going to rise to the sky? No, they will not. We're talking about extremely low level to start with, and it will remain very low. Remember, the number one force that is impacting defaults is not interest rates. It's unemployment. And as long as the unemployment rate is relatively low, the default story will not be a big story. This is not a 2008 recession like in the US. This is a very different story. But if you ask me a year from now, 2 years from now, will default will be higher than they are now? I would say yes.
But they're from a very, very low base,
Absolutely,
like
absolutely,
less than a
absolutely.
percent kind
And
of
the
thing.
stress test played a significant role here. Significant role here.
So how do banks deal with the demand, the desire to grow their asset base in an environment where it's very hard, where obviously mortgage applications are down, sale of homes is down, therefore mortgages are down, refinancings probably are down. So how do the banks deal with the fact that they want to grow their asset base in an environment where there are headwinds?
Well, it's tough. It's tough. No question about it that the banks are facing challenges. This is a recessionary year, if you wish, in terms of some of the drivers of asset growth. And you will see, and that's good. That's fine. That's the cycle. You cannot have non-stop year after year after year of mortgage growth rising by 7-8%. You should have a year that is 2%. I call it a reset year, and that's exactly what we're seeing.
There's got to
By
be
the
a
way,
huge.
that's exactly what's cooked in the market now when it comes to the price.
There's got to be a huge amount of pent-up demand that's for housing that's being built. You said we're gonna, we have 700,000, people coming to Canada in various ways, 500,000 just pure immigration. They're not currently buying as many houses as they were. Doesn't that ultimately lead, when rates go down to 2% kind of thing, you're going to have a huge amount of pent-up demand? And the other factor to that one is, because of supply chain issues, they're not building as quickly as they were for either condos or other new construction.
Nice, that's exactly the point. So what we are talking about now is this correction adjustment, if you wish, from crazy environment in COVID. So you go down for a year or two. But if you ask me where this market will be 5-6 years from now, you don't have to be an economist to predict what will happen. The supply is not there. We are still canceling supply. We are delaying supply while all those new immigrants are coming. The demand is there and will continue to be there. There will be a lot of pent-up demand.
The last 25 years in Canada, residential real estate across the country has appreciated 5.8%. If you were giving advice to your children and they said, Dad, what do you think happens over the next 25 years? Do you think 5.8% appreciation, not every year, but over a compounded over a 25-year period, is still reasonable expectation?
I would say yes. I think that the next few years will not be very strong, but overall, the demand-supply mismatch is so significant. And I would like to avoid this kind of situation. I would like this city to be affordable. And that's why what the Ford government is doing, quite frankly, is a step in the right direction in terms of allowing Bill 23, providing some supply into the system. That's actually a good thing.
The cap rates, have they really changed much? And will they change even though rates are much higher? There seems to be still huge amounts of liquidity, and transactions which are not that abundant are still happening at very low cap rates. Do you see cap rates changing over the next 24 months?
Yes, depends where. If you look at the office, I would say yes. If you look at the industrial, I would say no. I think that the mismatch in supply demand in industrial is so significant. We have a lot of demand, not enough supply, and buyers that are not price sensitive. So I don't see a significant change there. I'm very bullish on multi-residentials. I think multi-residential will be relatively strong because the demand is there and we don't have enough products. So it depends where you are.
Talk about return to office. What's your thesis about that? Where are we at today, and where do you think the trend is over the next 24 to 36 months?
I think more and more people will go to the office for longer. There is more pressure. Remember, with the labor market slowing down, the bargaining power of labor will go down and companies will have more power to demand people to come. Will it be back to what it was before COVID? No, I don't think so. I think it's a permanent change, but it's not going to be the way it is now. And we know that on a daily basis, if you look at downtown now, it's much busier than it was a few months ago. So things are changing and it will continue to change. More and more companies will demand people to go back to the office at least 3 days a week. Does it mean that the office will be strong? It will not be strong, but it will not be weak.
What are your institutional clients? What are the big issues that they talk to you about, they ask you about, and keeps them up at night?
Well, clearly, the geopolitical story is very important. What's happening with Russia, the Taiwan, China situation is something that they lose sleep over it because that can really change the dynamics in the market. And to what extent, inflation is going to last longer than expected. Namely, are we back to the 70s? That's clearly something that they are worried about.
When you read today that Putin has this big, huge nuclear weapon that he's put in place, could get to the United States, it could get to Europe. How we didn't talk about the fear and the issues that arise from, potential Ukraine-Russia issues getting out of control. What's the probability that becomes an issue?
Yeah,
and if so, what the impact?
That's something that unfortunately nobody knows. Nobody knows, including Putin probably. I think that what we are going to see during the winter at the Russia-Ukraine front is basically something relatively quiet. They will not be fighting too much in the winter. That's what I'm reading. That's what I'm hearing. And there might be another attack in the spring that might lead to some volatility in the market. Remember that the issue with Russia and the Ukraine is the oil issue, the impact on Europe. That will be less and less damaging over time because Europe is acting to substitute that oil. So that will be less significant. The US is estimating that something might happen between China and Taiwan within the next 2 years. That's something that we have to worry about. But at the same time, Miles, if we worry about every small thing that happens, we won't do anything. So that's the way it is. You have to basically go with the punches.
So what keeps Benjamin Tall up at night in relation to the issues that you research, comment on, and advise on?
A few things. One is, again, going back to the geopolitical stories, I simply cannot predict it. It's a bit scary. You never know. So you always worry about that. The other is that the way I see it is that companies will have to invest significantly in order to increase productivity. They will have to replace labor with capital. And they're going to do that. Which means that there will be an army of people that will be you will have an army of people that will be out of the labor market, less skilled people that will not be able to participate in the labor market. That will lead to income inequality that is going to widen. That worries me a lot. I see what's happening in the US, I see what's happening in Europe, and it's coming here to Canada. Income inequality is a major force that can lead to social unrest. So my nightmare scenario is this kind of situation. And therefore, I think that we have to work very hard to prevent it from happening. Part of it is immigration policy, but that's a different story.
Well, look, Benjamin, this is extremely insightful, very informative, and thought-provoking. Some of the stuff is stuff that I never had heard from anyone else, so it's very beneficial. And I think really dissecting inflation and the components of it really shed a lot of light on where we are and what the prospects are. So on behalf of all of us at Peerage and our partners, colleagues, family, and friends, thankful to have you and the support of CIBC. And to everyone on the call, thank you for your contribution and participation to be here. We want to wish, on behalf of Benjamin, myself, and our organizations, we want to wish you a very healthy, happy, sweet, and prosperous New Year and all the very best for the holiday season. And we hope to re-engage sometime in the new year. And best wishes to all of you and your families for the holiday seasons. And good luck and good night. Thank you.
Thank you very much. Bye-bye.
Take care.
Bye-bye.
Benjamin, thank you. That was great. Appreciate it. Take care.
Bye-bye.